Hi, welcome back to Joe Blogs. In today's episode, I want to talk about the recent jobs growth data that was released in the USA and why this could be really bad news for both the USA and also the global economy. At face value, the news looked extremely positive. 336,000 new jobs were added in September, which compared with 227,000 in August, and the figure of 100,000, which is seen as being the subsistence level that needs to grow in the USA just to keep the working population in employment. So overall, you would think that would represent really good news. And on top of that, we've also seen a 4.2% year-on-year growth in wages, which again, you would think is a positive development. However, the problem that we have is that those figures are a bit too good from the Fed's point of view, and so it increases the risk of the Fed increasing interest rates again. As I'm sure you'll be aware, one of the key targets for the Fed is to bring inflation down to the target level of 2%. The current official rate of inflation in the USA is 3.7%, so above that target 2%, and it's estimated that wage growth needs to be at 3.5% to achieve that 2% target. So 4.2% is significantly above where the Fed wants it to be. So we've got a combination of circumstances here that is now increasing the likelihood of the Fed raising rates again at a time when everybody thought that the Fed was done, that we weren't going to see any more increases in interest rates. And one of the reasons that increased interest rates is a risk for both the US economy and the global economy is that it will add to the interest burden for corporates who need to refinance their debt. And we have got thousands and thousands of companies that are classified as zombies. So these are companies that are carrying around enormous amounts of debt that they're struggling to be able to service. And if they have to refinance that debt at significantly higher rates, it could cause the defaults to rise significantly. So in today's video, I'll have a look at the volume of companies that need to refinance their debt during the course of 2024. We'll have a look at what's happened to interest rates over the course of the last 3 to 5 years, because a lot of these bonds have been put in place over that period, and see what the likely increase in cost is going to be for these companies. We'll then have a look at the latest S&P forecasts for the level of defaults that's expected in 2024 in the USA and Europe. We'll have a look at which countries around the world are currently in recession. Heads up, spoiler alert, there are 17 and 7 of those are based in Europe. And then finally today I'll wrap up with my summary as to what I think the risks are of a potential global recession hitting in 2024. Now before we get started on all of that, if you'd like to see more face-to-face videos like this without any annoying adverts and also see things that are not being posted on YouTube, then please check out my Patreon channel. However, if you don't like Patreon and you'd like to support the channel, please have a look below where you'll find links to buy me a coffee as well as YouTube's super thanks and membership scheme. This chart shows the annual issuance of corporate bonds in the USA split into 3 different categories. The blue bars represent investment grade bonds. So these are the companies that are rated as being the best in terms of risk, and therefore those loans are at the lowest possible coupon. The red section represents high yield or non-investment grade bonds. So these are companies that have a lower rating and pay a higher coupon. And the gold section are institutional leveraged loans. So that's basically large loans to highly leveraged companies, so high risk, being provided by banks and financial institutions. Now this chart goes back to 2007, which was before the global financial crisis, which kicked in 2008. And one of the interesting things to note is the amount of debt that was issued in 2007, which was the peak of the market before the financial crash. In that year, the total issuance of high-yield bonds was around 125 billion, investment-grade bonds were around 250 billion, and institutional leveraged loans were around 400 billion. So that equates to total debt of around $775 billion. Now, the maturity profile of corporate bonds and loans differs, but the vast majority of the market is either 3-year, 5-year, or 10-year money. So if we start off by looking at 2013, which was 10 years ago, if all of the bonds that were issued in that year had a 10-year maturity, then they would all be up for renewal now. They would need to be refinanced this year. And you can see from the chart that in 2013, $275 billion worth of high-yield bonds were issued, $325 billion worth of leveraged loans were issued, and $450 billion worth of investment-grade bonds, which gives us a total of over $1 trillion worth of debt. If we now have a look at this chart, which shows the official rate of interest in the United States over the last 10 years, you can see that 10 years ago, the official rate of interest was sitting at around 0.5%. So that means that all of the bonds and loans that were issued in that year would have had a coupon that was linked to that very low level of interest. So maybe 1%, 1.5%, 2% for a lot of these loans. If we now look at the situation today, you can see that the official rate of interest in the USA is sitting at 5.5%, which is more than 10 times higher than it was 10 years ago. And that means that any company that is refinancing its debt today is going to have to refinance at rates above that level. So likely to be 6.5%, 7%, possibly as high as 8 or 9%, depending on the credit risk of the company. So that means that if you're a corporate that has a 10-year bond that needs to be refinanced right now, you could potentially be looking at an increase in your debt coupon of 4 or 5 times what you've been paying historically. And for a lot of businesses, that is going to be completely unaffordable and may cause these companies to go into an insolvent situation. And if we jump back to this chart and have a look at the amount of debt that was issued in 2013, 14, 15, 16, 17, and 18, which is 5 years ago. So theoretically, all of that debt is coming up for renewal at some point either this year, next year, or the following 3 years. There is a total of $3 trillion worth of investment-grade bonds, $1.4 trillion worth of high-yield bonds, and $3.4 trillion worth of leveraged loans that were issued in that 5-year period, all of which are now staring down the barrel of significantly higher rates of interest. And this is going to cause major problems for all of these companies that have issued this debt. And of course, companies didn't stop issuing debt in 2018. There was also a significant amount of debt issued in 2018, 19, 20, 21, and 22. And if those bonds and loans had a maturity of less than 5 years, they will also be coming up for renewal now. So the overall summary of this chart is that there is a mountain of debt, significantly more than there was in 2007, that is waiting to be refinanced. And all of these loans are going to be refinancing at much higher rates of interest. This chart shows the total value of all non-investment grade loans and bonds that have been issued by companies in Europe, the Middle East and Africa that are due to mature over the course of the next 2.5 years. And what this shows is that over the course of the next 18 months, there is around $1.3 trillion worth of bonds and loans that need to be refinanced. And all of these companies will now be locking in at significantly higher rates of interest. This chart shows the movement in the official rate of interest for the euro area over the last 10 years. And you can see that 10 years ago, the official rate of interest was 0.25%. However, today, it's now 4.5%. So that represents an increase of more than 10 times during that period. And in exactly the same way as we've just discussed for the USA, we have got a mountain of debt that is sitting waiting to be refinanced. And a lot of the companies that have these debt burdens simply won't be able to afford an increase of 10 times in their interest burden. This chart shows the historic default rate in the USA for high yield or non-investment grade bonds dating back to January 2020. And you can see that in that year, the default rate was 3.2%. However, as a direct result of the COVID-19 pandemic, which struck the globe during 2020, default rates actually increased to around 6.5%. However, in 2022, there was a significant reduction, and over the course of the last 12 months, default rates have been below 2.5%. Now, as you can see from the right-hand side of this chart, the 3 dotted lines plot 3 different scenarios that S&P have put together based on their expectations of what is going to happen over the course of the next 18 months. Their most pessimistic scenario assumes that default rates increase to 6.25%, and under this scenario, S&P sees the USA entering a prolonged period of low growth with persistent price pressures and higher for longer interest rates. Their base case scenario, which is the one that they expect to be most realistic, is that default rates increase to 4.25%, and under this scenario, balance sheet liquidity gives way amid persistent cash flow constraints, and tight financial conditions will restrict access to capital for companies. The most optimistic scenario sees the default rate reducing from the current level of 2.5% to 1.75%, as macroeconomic pressures resolve and financial conditions ease. This chart shows the same data that we've just looked at for the USA for Europe. So you can see that in January 2020, the default rate was 2.53%. During the course of the COVID-19 pandemic, the rate increased to 6%. It then dropped to around 1.5%, and over the course of the last 12 months has increased to the current level of 3.05%. Now, I think it's really interesting to note that although the current default rate of 3.05% is higher than the current rate of 2.5% in the USA, the three projected rates for 2024 for Europe are actually lower than they are for the USA. The pessimistic scenario forecasts a default rate of 5.5%. The base scenario for Europe assumes a default rate of 3.75%. And as with the USA, the optimistic scenario assumes 1.75% default. Now, whilst we're talking about the risk of recession, I thought it'd be interesting to look at which countries are currently in recession and which are on the verge. And this chart shows the last 2 quarters of GDP growth released by every country in the world. And I've ranked this table from the worst performing to the best performing. Now, the technical definition of a recession is 2 consecutive quarters of falling GDP. So if we've got 2 minus figures on this chart, it tells us that that country is in recession. So you can see that right at the top of this list is Afghanistan. And actually the last figures that we had officially from Afghanistan were for December 2021. So these are horribly out of date. But I think it's safe to say that Afghanistan is still in recession. It's not really a booming economy in that context. Libya is the second worst performer in terms of the most recent GDP figures. However, technically it's not in recession because the previous quarter showed 28% growth. But once again, that relates to December 2022, so it's out of date, and it's likely that Libya is in recession. It's a war-torn country. Argentina, interestingly, isn't in recession, despite the fact that it posted a fall of 4.9% in GDP in June. But it's very likely that Argentina will go into recession when we see the figures for September. Burkina Faso is in recession because it's posted 2 consecutive falls in GDP. The next country in recession is Sri Lanka, as is South Sudan, Estonia, Hungary, Moldova, New Caledonia, Belarus, Haiti, Luxembourg, Chile, Poland, Czech Republic, Peru. Finland is almost in recession. It had 0 growth in the previous quarter and 0.4 in the most recent. North Korea, Netherlands is also skirting on the edge of recession, and Germany is the last country on this list that is showing as being officially in recession. And I think what's interesting about these figures is that there are 17 countries now officially in recession, 7 of which are located in Europe, the largest being Germany, with a population of around 83 million, and also Germany is the 4th largest economy in the world. However, we've also got another 6 countries in Europe that are on the verge of recession, which are the Netherlands, Sweden, Austria, Finland, Ireland, and Latvia. And there are also a variety of other countries on the verge of recession, including Argentina and Uruguay. So what's the summary and conclusion today? Well, I wanted to post this video because the latest data that's been released in the USA, at face value, looks like great news for the USA economy. However, as we've discussed in today's video, it's a little bit too good in terms of the news, and there is a possibility that the Fed may see things as being a bit too hot in the market right now, and that they need to apply the brakes a little bit harder to bring the US economy back in line with where they want it to be, with a particular focus on that 2% inflation. Now, obviously, over the course of the last 12 months, we have seen repeated interest rate rises. So this isn't a new development. But the reason that the markets are worried is that they thought that the rate rises were finished, that we had hit the top, and we are now going to see a period of stability with a possibility of reducing rates at some point over the course of the next 12 months. But if we're now going to see a renewal of these interest rate increases, then that could have some serious consequences for companies that are sitting with large amounts of debt. And as we've seen from the data today, we've got around $3 trillion worth of high yield debt that needs to be refinanced over the course of the next 12 months. And as rates continue to rise, all of the companies that are in that position that need to refinance their debt are going to see a huge increase in their interest costs. And many of these companies are already struggling with the debt at low rates. So when a higher interest rate is applied to that debt, it's going to apply more pressure to those companies, and it's likely that we will see a rise in defaults. And as we see a rise in defaults, that could trigger a recession. Now, if we talk about the USA first, it's unlikely that the USA is going to go into recession in 2024, but it's the biggest economy in the world. So if there is a slowdown, if there's a deliberate policy to try to bring things back in line by the Fed, then that's going to have a knock-on impact to lots of other economies, because the USA is buying things from all around the world. So if the USA slows down a little, doesn't go into recession but slows down, then that is likely to have a domino effect. And countries that are currently sitting on the verge of recession, and we looked at the list earlier, that might push them over, and you may find that those economies are really struggling. And of course, the domino effect isn't just limited to the USA. It applies to every single economy in the world. So as we see more and more economies going into recession, that will have a trigger effect on the people that they're trading with, and so it goes on. So there could be a really serious ripple effect here. So that's one of the reasons I wanted to post this video, is that when you see news in the mainstream press, such as the USA has just released its job data and it's better than expected, you immediately think, well, that's great news. Everybody's doing really well. This means that 2024 should represent some serious growth all around the world. But actually, if the news is too good, if you're overachieving, then institutions like the Fed need to do something about that to bring you back in line. And that can have serious consequences for lots of other countries. So hopefully you've enjoyed today's episode. You found it useful, informative and thought-provoking. If you've liked what I said, then please give me a thumbs up. Thank you for watching this video all the way through to the end. And here's something to put a smile on your face.